Hey everybody, welcome back to another beautiful day in real estate. Today, you guys, we have a lot of stuff to cover, and we're gonna dive into it right away. But you guys, we've been doing videos for about a month now, and we're bringing them every single day to you guys. If you like what you're seeing, obviously we'd love it if you'd subscribe. We're gonna keep pushing out content for real estate, economics. We're gonna be talking about the war until it ends, and we're gonna guide you through what you should be doing right now or what you should be paying attention to. I'm a big investor. I love to invest, but I also love real estate. So I realize that on a channel like this, especially where we should be talking about real estate, we need to talk about things that are going to directly correlate to the real estate market. So my goal here is to provide as much information as I can. I'm going to compare a lot more of the 2008 versus 2026, and I'm going to talk about the differences. I'm going to talk about why I think there's going to be an issue with private credit versus real estate. And yeah, so when we go through, I'll kind of explain as we go, but make sure you guys are interacting with this. It helps me out a lot, and we'll keep doing what we're doing. So anyways, because of yesterday's ceasefire deal, and I quotation that because it lasted about 12 effing hours, but we saw interest rates start to go down, right? We saw them go down from 6.44 and 5.9, 5.9. So these are actually going down a little bit as well. So I mean, you guys, if you're an FHA buyer, you're in the fives right now on average, depending on credit scores and stuff like that. But VA 5.9, the conventional year at 6.4. But this is not terrible. This is not terrible, you guys. Everybody thinks because we're in the sixes, it's absolutely awful. But I mean, dude, I am seeing people buy houses in the sixes right now. People are coming up. They're not complaining about interest rates anymore. They're complaining about how expensive everything is. And I shouldn't say complaining, but that's like the main topic, right? People are worried that things are going to continue to get more expensive, so they're buying houses. People are scared too, and a lot of them aren't buying houses because they feel like the market's going to crash. And that's why it's my responsibility, I feel, to explain to you guys what that means and show you how it's not going to actually crash. So anyways, oil prices, you guys, will start on this. Again, oil prices directly correlate to the 10-year bond. The 10-year bond correlates to mortgage rates, right? So we're going to talk about those today again. So yesterday, we saw, after the announcement of the Strait of Hormuz, the ceasefire deal and the opening of Strait of Hormuz, we saw a major dump all the way down to support. The support was right around that 92. It's kind of crazy how accurate this stuff can be. Anyway, so our trend line, we broke below it, and then we fell down to support. Support's right here. If it would have broke below this, we would have went way farther down. But as of right now, there's too much uncertainty for it to keep going south. I say south is to keep going down. Anyways, we saw a lot of buying pressure. Now we're heading back up, but we don't have a lot of volume just yet this morning. The market opened 12 minutes ago, and we're already heading north pretty significantly, I guess, we started at 92. We're up to about 99 right now. But this right here, that 100 is going to be kind of it's like a mental resistance, right? So I mean, we're seeing here volume, right? So it might break through, and then if it does, it'll go back up to 115. But for right now, things are starting off a little more bearish again this morning. And the reason they're starting off bearish is because we can't seem to get news that's consistent across the board. If you're looking at Iranian news versus the United States news, everything is all over the place. Strait of Hormuz is open in the United States. It's closed in Iran. I mean, there's attacks on Lebanon, and Israel's responsible for it. I mean, it's so unpredictable right now. And the unfortunate part is people are actually dying because people feel like they need to play God. But it is what it is. So here we go, guys. The 10-year Treasury bond, as we were talking about, U.S. government bonds, it bounced off support kind of below in that range we were talking about, right? We were talking about support was going to be right around that 4.27. It broke right below, didn't bounce all the way off our trend line here. So if we're talking about a trend line, granted, it's not significant, but we do have 1, 2, 3, 4 bounces off of it is resistance, and then it broke above. And now it's kind of retesting if we keep heading north. But right now, we might keep going higher. We could go back up into those 4.5s or 4.8s, depending on how the war progresses, really. The stochastic went all the way down. Again, this is just trading mumbo jumbo, but stochastic and the RSI, they both kind of proved a point. Like we said, we saw the highs, we saw lower highs, and then it went down. We saw the highs, we saw a retest below that trend line, and we started going down. We're going to find out today with the war in Iran where things are going to go, depending on the news, depending on how it reacts. It's It's really the deciding factor, right? So the first thing that we saw right away is they said that the Strait of Hormuz was open yesterday. And that, again, guys, that's like 60% of the world's oil goes through there. And the reason that the United States doesn't give a shit is because we don't get any of our oil from there, right? We have Venezuelan oil now. So countries are getting they are getting strangled at the neck for oil. And the reason is, okay, so again, we have to remove our opinions from politics for 15 seconds here. We just set them aside. Let's focus on what is, right? Not what we want to happen, but what is actually happening, right? Right now, the oil is getting restricted flow through the Strait of Hormuz unless Iran wants you buying them in the yuan, right, which is Chinese currency. The United States went out, got Venezuela, which has a big proportion of the world's oil, and now we own, or I shouldn't say we, but the United States owns that much oil, and they're going after this, and in my opinion, it's more of a control move than anything. The frustrating thing is that we get to deal with the oil price or the gas prices going up because, because they're saying, well, the Strait of Hormuz is choking things off. We get none of our oil from them, but it's still we get to take care of that pricing. We get to eat that pricing. But anyways, so what's happening is basically they're saying it's an unwinnable war, right? Iran's never going to surrender. The United States is never going to give up, etc. But what's happening is when you restrict that oil, people still need oil for petroleum to get gas. Oil is used in thousands of products, right? It's not just your gas. It's not just the oil for your car. It's used in thousands of different products. But countries are getting their oil from there. And if they don't have a place to go, the theory is they're going to have to buy it from the United States. So that's, if you want the broad spectrum of it, that I think is the goal. I think the goal is to have all the control so that people have to, I shouldn't say people, but countries have to purchase their oil from the United States. But the frustrating thing is, like I said, is only 4 ships passed through the Strait of Hormuz yesterday, the lowest daily crossings in all of April. Granted, it's only the 9th, but that means that there's a lot of back and forth right now, and I just, it's frustrating, but we're not going to see anything anytime soon. I think people need to start preparing for that, but that's why I keep telling people you need to be in more certain assets. You need to be in hard assets. I'm going to tell you real estate is better to be in right now than a lot of things. People just think because prices went up, real estate's going to crash. It's not. I'm sorry, but I don't think it is. And we're going to talk about that next. We're going to move into the private credit market, right? So what's going on with the real estate market? I did some side-by-side comparison using Claude. You guys, if you're not using ChatGPT and Claude and other programs, you guys are kind of losing. You guys are behind the ball right now. We utilize this stuff every single day. But anyways, so the private credit market is now facing the worst crises ever. In Q1 of 2026, investors requested $14 billion in redemptions from private credit funds, the highest ever. What's even worse is almost 50% of those redemptions weren't allowed, which hasn't happened before. Even large institutions, like banks like BlackRock, Morgan Stanley, halted withdrawals, which shows the private credit market is breaking down. So you guys want to know something kind of crazy about this private credit market? The inception of this was 2008. Post-2008 inception. This was created right after the worst financial crises in modern history. A sharp acceleration has forced several high-profile business development companies to slash their dividends and gate redemptions, meaning that they're not giving dividends on these stocks anymore, and they're not allowing people to pull their money out. Why? Because there's no money to pull out. We're a debt-based society, leveraging every bit of the money that's in it. Banks can leverage 95% of your money, every 90%. Every dollar that goes in, 90 cents is borrowed out. It's used to borrow. So if I put $100 in there, or let's say $100,000, and you want a $100,000 car, you get to borrow my money from the bank. But the bank is going to say, no, you have $100,000 in your account, but we borrowed your money to somebody else. So if I went in there and said, I want my money, I wouldn't be able to get my money. That's why I don't keep a lot of money in the bank. I keep a portion, but that's the dangerous part, right? Like you have the FDIC who says, yeah. If your bank goes under, then you are insured for up to $250,000. That could take months, it could take years, depending on court proceedings, etc. But all they did is they just moved money in a different place. So this is why I'm going to start here, because the 2008 market versus this year's market is very different for real estate, but private credit is what's cracking. Private credit is $1.8 trillion market. It's a $1.8 trillion market, right? And right now, there was 14 billion, as we just read, that were trying to be pulled out in Q1 of 2026, but over 50% of it couldn't get pulled out because they don't have the liquidity to do so. So what does that mean? Okay, let's talk about real estate and then we'll go into that. So I did pull some data. I did have it side by side, compared 2008 versus 2026. Months of inventory in 2008, mid the historic oversupply of 11.2 months. Okay, we're at 3.8 on average. So that was the NAR data that pulled that. So huge difference. Very, 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 very big difference, you guys. You need over excessive inventory. Now, there has been data coming around, or there has been a chart that says there's 600,000 buyers or sellers versus buyers, the 200 some thousand buyers. That's on average, and that's different markets. Again, it's all about how you perceive the data. So I can turn data and turn it into a positive, even though it's negative. So be careful what you're watching, because again, headlines are meant to scare you, and they're meant to draw you in to help you, help them create views, etc. Right? Okay. So active listings at that time in 2008, at the peak of the market, it was 4.5 million. The active listings now are 1.27 million. Again, we're 4 times less on the active market, right? So they put balanced market or 6 months of inventory. So when you're in real estate, 6 months of inventory means that if we stop listing homes today, we'd have about 6 months of inventory before it would sell off and then we'd run out, right? So the data is stating that there's an opportunity. Basically, they're saying right now we're still in a, well, technically we're still in a seller's market. It doesn't feel that way, but we still are in a seller's market. The problem is most sellers thought their houses were worth more than they actually were, that they actually are, because COVID overinflated them. But again, another conversation. I don't want to get too sidetracked. But right there, you guys, the months of supply and active listings substantially lower than 2008. Again, real estate, it's not real estate, you guys. Let's get into it. Foreclosure filings, 2008 peak versus today. 2.87 million foreclosures. An annual height of mortgage crisis. Right now, 340,000, up 7% year over year. Excuse me. So again, let's talk about this. There's data going around saying that the foreclosures have doubled in the last year. Right, but there was 100 and whatever, it'd be 150, 60, 70, 80, 160, 170. Holy shit, I can't think today. Anyways, so basically, if you're going, you're still, what are we, about 2.45 million less bankruptcy filings than 2008, or the height of 2008. We're not even close. Like we're not even close. If we talk about 2022, 3, 4, dude, we're not even close to seeing a major increase, right? 2006, 2007, leading into 2008, we were at, holy shoot, we were at 1.2 million, 2.3 million, 2.8, 2.87. So like we saw a significant amount even years before. And even in 2006, before the market was even collapsing, we were at 770. Like we're not even remarkably close, right? Monthly filings, 11 straight monthly gains. I mean, it is slightly ticking up, but it's not anywhere near, right? We had 8.5 times the amount of filings at the peak of 2010 versus than the current pace. We're not even close to a crash in the real estate market, right? So the next thing, you guys, subprime mortgages versus subprime auto loans. This is another one that most people don't pay attention to, and it actually kind of gets me excited because it's not a hard market to figure out. Dude, I met with somebody the other day. Their car payment is $1,200 a month. $1,200 a month, dude. My mortgage is $1,700. That's insane. You're paying $1,200 a month for a car. Like, some people, they might have their, like, again, I'm not judging finances because, dude, I pay $800 a month for my truck. Do not care. Love my truck. Never. But I know how to manage my money a little bit better. But right now, look at this chart, dude. It's nuts to me. 2001, 3, 4, 5, 6 subprime mortgages, right? Subprime auto loans from 2021 to 2025. That's the market people are talking about. We're $1.2, $1.3 trillion in auto loan debt right now. People are belly up on their fucking vehicles because they bought them during COVID when there was a minimum supply, right? Same thing with real estate. So they bought them at inflated prices. Dude, I bought a car in 2018. I bought my Volkswagen 2018 Jetta GLI, which again, I know it's not a great investment. Leave me alone. Love my comfy cars. Came back on the lot in 22. I was like, you know what? I want a family car. I got a girlfriend now. I want to get something that's a little bit more practical for her to drive. I traded it in for a Tiguan. I made money on that car. I traded it in for more than I bought it for. That'll never happen again. But that's where we were, right? We saw the overinflated market of cars. And then what happened was interest rates went back up into the 6s and the 7s. And now people can't afford their cars, or not as many people are out there buying cars because most of them are belly up. I remember when I went to go trade that Tiguan in for a new one, they were like, yeah, you're going to carry over $10,000 in negative equity. I go, huh? He's like, yeah. I was like, no. I told you if we did a straight trade, I'd take it. No. Car's already in the back. We're already getting it detailed. Let's just keep moving. I'm like, dude, no. But I had a conversation with the guy, and apparently that's what everybody's doing. They're just glossing over that, and they're like, nah, man, we're good. We'll be okay. We'll just take it. So people now are paying more for their cars at a higher interest rate, and then they're carrying negative equity over because God forbid you pay off the car you have, or at least drive the same car for the next 4 years. Again, I'm not judging. I'm very bad at that too. I love buying new cars, man. I do not give a shit. I pay gross amounts of money for vehicles. But anyway, people are over leveraging themselves in car debt. And that is where we're finding issues. People are not foreclosing on their homes. They're utilizing and they're running up their credit card debt, and they're running up the debt when it comes to cars. Those are the two markets that I think we're going to see more issues in, right? So 2008 subprime versus auto loans, again, just kind of going into the depth, right? So $1.66 trillion in total debt right now. Oh my God, that's insane. It went up $400 billion in the last 3 months. That's crazy. Holy shit, dude. 1.3 to 1.5 trillion subprimes outstanding. Dude, we are higher now for the mortgage or subprime auto loans than we were for than we were for mortgage loans in 2008. Oh my God. Oh my God, that's insane. 25 to 35%, 25 to 30 auto loans, shares of okay. 60-day delinquencies. So we're up from 21% in 2008 to 25 to 40%. Dude, the amount of people that are getting their cars repoed, even in Bismarck, North Dakota, 70,000 people. A buddy showed me that. He's a repo guy here. Dude, he showed me his app. It looked worse than looking at the Sex Predator website, man. They were everywhere. There was spots everywhere. People have their homes or their cars that are getting repoed. Dude, that's crazy. 7 to 8 year auto loans are now common. 7 to 8 years, dude. I'm reading this stuff. I didn't even read through all of it because I just wanted to pull the data and do it live on here. But my God, dude, I'm not even going to get into that now, dude. Like, I'm just too blown the F away right now. That's, wow, $1.6 trillion in auto loan debt. Dude, we're not even, the real estate market's not going to crash. The auto loan market's going to crash. The credit market's going to crash. The credit card market is over leveraged. Oh my God. Don't get me wrong. Real estate will correct with it, but it's not going to be the sole deciding factor. People are waiting for it, focusing on real estate, comparing it to 2008, but 2008 is so much different than it was now. Wow, that's insane to me. Okay, anyways, recoup, figure it out. Let's go back to this. Okay, we're getting to the end of the day. We got to kind of power through the last 2 minutes here. But anyway, so the next thing I was going to talk about, you guys, is how we're probably going to see, what we're going to probably see, right? So Kevin Warsh is supposed to be coming into office in May of this year, right? So Kevin Warsh is talking about lowering interest rates. Kevin Hassett, who is actually a part of the White House cabinet, who was one of the candidates for the nominee, said that Jerome Powell is probably not going to be on the team anymore moving forward, or not the team, but on the board for the Federal Reserve. I just don't think that he's going to align with the amount of people. Anyways, let's get to it. So the U.S. job market is weakening. So what happens when the U.S. job market weakens? We move towards a recession, and liquidity needs to be pushed into the market, and interest rates go lower, right? So the number of unemployed Americans for 15 plus weeks is up to 3.3 million, the highest since September of 21. This figure has risen 1.6 million since July of 22. That's a pretty significant amount of people. Holy shit. And as a percent of total employment, this indicator is up 20%, the highest since October of 2021. Since the 1950s, each time this percentage has been this elevated, the U.S. economy was already in a recession. This is the problem that people don't understand. They are calling for a recession, but dude, we are in a recession. It's not like the ones where during the previous administration where they changed the goalposts. Like, this is a recession. Actually, no, it has to be a little worse. Actually, it has to be a little worse. Like, we're in a full-blown recession right now, okay? As a result, the average duration of unemployment is 25.3 weeks, only below the post-pandemic levels of 2021 and the post-2008 financial crisis recovery. Long-term employment is considered concerningly high. That's crazy when long-term unemployment is considered an issue. Dude, reading this data is just blowing my effing mind this morning. But anyways, so what all that means is I still believe we're in a recession now. We're already seeing that. Like, don't get me wrong, the real estate market or the stock market is overinflated, insanely overly inflated, dude. Like, we could to I guess be in a definition for a recession, we should see about a 22 to 23% retraction from all-time highs in the S&P, and we're only down about 10. So I mean, like, per the data, technically we're not, but it's a little bit, I think we're in a little bit different world. But anyways, continue, I'll finalize here and I'll wrap this up. But the US GDP growth falls from 4.4% to 0.5% in Q4 of 2025, well below the initial expected 2.8 growth. Again, when we don't see growth, we have to create liquidity so that more businesses can create. We have to do lower interest rates so more companies borrow more money, okay? So when you're not seeing GDP growth, companies need more money to grow their businesses. And when you have higher interest rates, companies usually are going the opposite way. They're slimming down on employees. They're cutting back on costs. They're not borrowing money. They're not taking risks because there's so much uncertainty. This is going to be a correlating factor that's going to put the money printer back on, or they're going to have to do something to create more liquidity in the market. And right now, to me, it just seems like we're almost there. And then the last one that I'll touch on is the watcher guru here, but he says Treasury Bassinet says that interest rates should be lower. This guy gets it. Turn on the money printer, right? So all of those three things are going to correlate to needing to print more money. Now, even if we see a humongous crack if we see a big crack in the private sector, private credit market, dude, that's a $1.8 trillion industry. Remember, 2008, dude, was $1 trillion industry that collapsed. We are at a 1.8, so we are almost double where we were. Granted, we have, money's worth about half of what it was worth then, but still, that poses an issue, right? So I think I'm going to say that my confidence is going to lie with when the next head of Treasury. Not Treasury. Good Lord, just read that. The next head of the Federal Reserve is inaugurated May 15th. I think we're going to see the money printer turned on. I think interest rates are going to go lower, and I think people are going to be wishing they bought houses at the beginning of the year, as I've been telling people for weeks now. But all that going on at one point, you guys, we'll keep diving into this. If you felt this was interesting, or you felt like it was, something drawing you in, just let me know, man. Like, comment below if you have questions, if you feel like I didn't explain something very well. But remember, we have to look at things from a 30,000-foot overview, and it's history rhymes, it doesn't repeat. So we're not going to see what happened in 2008. We're going to see another issue. And again, it's private credit, it's auto loans, and it's credit cards. Those are the three things right now that have major liquidity issues and huge amounts of debt over long periods of time. So we'll go into this more in depth as we progress, but thanks for watching, you guys. Have a great day, and we'll see you next time.